Good morning. This is Bloomberg Daybreak Europe. Happy Friday. I'm Tom McKenzie in London. These are the stories that set your agenda. Brace for more. Futures point to the global sell-off continuing after President Trump's tariff announcement wipes close to $2.5 trillion from the US stock market. That's the biggest decline since 2020. Oil extends a sharp drop after OPEC Plus unexpectedly increases supply. Show me the money. President Trump says he is open to reducing tariffs if other nations offer something, quote, phenomenal in negotiations. Plus, French President Emmanuel Macron urges companies to pause their investments in the US. Germany also pushing for a more robust European response to Trump's tariffs. Happy Friday. Trading day 2 of this new global order as Trump forces a reworking of our world economy. European futures pointing to further losses after dropping 2.6% yesterday, currently pointing lower by 0.8%. The markets, of course, adjusting their views around the central bank action to try and support these global economies, with the ECB in the mix, as well as the BO and the Fed, in terms of rates being pulled forward by traders. FTSE 100 futures pointing lower by 0.3%. S&P futures, after the rout of yesterday, closing lower by almost 5%. The Nasdaq closing down by around 6%. The Russell 2000 crushed, dropping 6.6% by the end of the close. And looking to build on that today. US futures down 0.8%. Nasdaq 100 futures dropping 186 points, now lower by a full percentage point after the rout of yesterday of 6%. In terms of the money moves into treasuries, that continues across the curve from the 2s all the way through to the 10s. You are now seeing sub 4%. It's only at the 30s where you're holding above 4%. 397 right now on the US 10-year, given the money flows in. Yields down on treasuries, price up. Bloomberg Dollar Index currently down 0.3% after dropping to its lowest level yesterday on an intraday basis since 2005. Brent at $69 a barrel, down 1.1%. Further losses for oil after that surprise decision by OPEC Plus to put more oil on the market in the face of the risks around recession. Gold at 3,100, a little softer in the session by 0.5%. A little bit of money being taken out of the yellow metal. Let's cross over to Asia right now. Abraham standing by in Singapore, and another brutal day for Japan.
Absolutely. That is the market that is underperforming today. Tom, I really actually wanted to talk to you about how Asia's stock market's not faring as badly as Wall Street, but I really can't say that's the case now because Japan is extending those declines. And to give you a sense of that de-risking, repositioning underway in this part of the world, look at the gauge, the Nikkei, and how these losses are the steepest that we've seen since late September. It's really the drag that you're seeing from the Japanese lenders. Another clue as to the amount of traders that are taking risk off the table as we head into the weekend, the Singapore stock benchmark. I know this is something we don't mention very often, but it's seen as a sort of safe haven in the Southeast Asian region. This gauge slipping by the most since the yen carry trade unwind. And amid all this, of course, investors are really assessing the damage from the tariff shock for China. Today, China, Hong Kong, Taiwan markets are shut. So for that assessment, let's look to the renminbi. Flip the board, take a look at how dollar China. I just wanted to show you not so long ago, after the tariff announcement, we saw that spike, and look at how it's pushing lower at the moment. This is a bit of a head scratcher, given how Fitch has downgraded China to A, saying that the outlook is stable. This is a downgrade that China has rejected. But also interesting, we had the likes of Jeffrey saying that China could devalue the renminbi as much as 30% given the tariff risk. So a bit of a head scratcher amid all this, why the Chinese yuan is climbing. We had the likes of Mark Cranfield saying that maybe because of the spike just a day ago in dollar China, maybe short-term positioning, they were caught out. So this is the reaction you're seeing in markets today, maybe also to do with the slide in the US dollar. Let's flip the board, take a look at how that is also being quite helpful for other currencies in the region, including the Vietnam dong, which just a day ago plunged to a record low. Today moving sideways. There's also a sense that even though Asia's central banks are likely to ease more aggressively this year, there are some outperformances, including in the likes of the Philippine peso, Malaysian ringgit. Tom.
OK, Avery Hong in Singapore with the market check this Friday as we see those adjustments continuing, of course, risk off across the Asian session. US futures, of course, in the red as well as investors brace for more pain after Wall Street suffered its worst day in 5 years. The US president, though, says he's not worried.
I think it's going very well. The markets are going to boom. The stock is going to boom. The country is going to boom. And the rest of the world wants to see, is there any way they can make a deal? They've taken advantage of us for many, many years. For many years, we've been at the wrong side of the ball. And I'll tell you what, I think it's going to be unbelievable.
OK, let's bring in Bloomberg's Valerie Teitel with a focus, of course, on the markets. And what an historic day for the readjustments that we saw yesterday, Val. Just take a step back and give us the breadth and scale of some of the moves that we saw yesterday.
Yeah, Tom, historic day for the U.S. Equity market. The S&P 500 sliding near 5%. It now joins the board of some of the worst days for the U.S. equity market in the last century, comparable to one of the worst days of the dot-com bubble, to the worst days of the GFC, and even comparable to when the U.S. was downgraded back in 2011. There were some indices that entered into a bear market. One of them being the Mag 7 is now down 24% since its peak only back in December. Also, the Russell 2000 index has also entered a bear market. It's now down over 20% since its peak back in January. Now, sectors that have been on the move, there were two that had some pretty brutal declines. One of them being the banking sector. The KBW banking index had its worst day since the fallout from the regional banking crisis back in March 2023. A lot of this also aggravated by the widening of credit spreads, Tom. That is not a good outlook for the banking sector when we start thinking about entering into a growth slowdown. Also, we saw the chips index, that's the SOX index, having one of its worst days since the COVID era of March 2020, down 10% as well. I also want to note, though, that this widening of credit spreads, it wasn't just in the U.S., it was global as well, Tom.
And we have, of course, non-farm payrolls data later today, backward looking as well. What are you going to be looking at when it comes to that data, Val? And comments as well from Jay Powell, separate, of course, to the data. We're going to hear from the Fed chief. Does the Fed ride to the rescue?
Look, Tom, it's funny. I mean, I don't think traders even know what their P&L is from yesterday, and we're headed into two major market catalysts today. The first one being the non-farm payrolls, questions of whether we're going to see any hints of an exacerbated labor market weakening maybe sooner than expected. But the estimates are for the unemployment rate to hold steady at 4.1%. Non-farm payrolls, the headline number at 140K. We do hear from Powell speaking a few hours after this release, and he is speaking as the market is now pricing in increasingly more amounts of cuts from the Federal Reserve. It was just back in January we're pricing 2 cuts this year. We're now pricing 4. Will Powell in some way echo this pessimism around the U.S. economy, or will he repeat his lines from the previous press conference about how the U.S. economy is resilient?
Bloomberg's Valerie Teitel, thank you very much indeed. Now, President Trump says he is open to negotiations, contradicting his top aides who insist the sweeping tariffs are not a bargaining tactic.
It depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good. For instance, with TikTok as an example, we have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff?
Let's get the latest now with Bloomberg's EMEA News Director, Ros Matterson. And Ros, when I speak to some investors, they'll say, look, if we just get some clarity on the tariffs, even if the tariffs are coming, just some clarity and an end to the mixed messages in terms of what we hear from the president, that would be in some way helpful. We're getting both the tariffs and the mixed messages still.
Well, that's right. Well, actually, if you were in the Antarctic territory of Heard or McDonald Islands, you might have some clarity where there's nothing but penguins. They were on the list for tariffs, and now they're off. So at least some of these territories around the world now seem to have a reprieve. But as you say, there's still a lot of confusion here about what exactly these tariffs are. We know that some of them got adjusted again overnight because there were differences between what Donald Trump announced and what was in annexes. For example, we have a lot of leaders lining up to try and call Donald Trump to get him on the phone to get some clarity about whether they can have any kind of reprieve. As you were saying, the message yesterday from all his inner circle was Donald Trump is standing firm on this. This is resolute territory. But again, we had Donald Trump himself saying, well, if it's phenomenal, in his words, it's a very good deal, I'll look at it. So leaders are really going to try and use this window over the next couple of days to try and get him on the phone and pitch their case for some kind of reprieve. The question is, does anyone get below 10%? And it seems like 10% really is likely to be the floor, especially for countries that are currently sitting around 30, 40%. So they won't go to nothing necessarily, but they might get a little bit of negotiating ground. The big one, as you say, is China. You can see the indications there from Donald Trump that if China does sign off on the US sale of the sale of the US operations of TikTok, perhaps that's enough for him to give some reprieve to China. So that's very much one to watch.
And where do we stand? We have the China piece then, Ros. Where do we stand on the sectoral tariffs? There was some modest relief when I spoke to the trade minister over in Ireland that there had not been sectoral tariffs on the pharmaceutical industry. Do we now assume that that is still coming down the pike at some point, or is that now off in terms of how the Trump administration is thinking?
Well, it's certainly still on the table. I mean, what Donald Trump was saying is that he was going to do sectoral tariffs separately to reciprocal tariffs. And then he went ahead anyway and announced auto tariffs before he did reciprocal tariffs. So he's always said there are other ones that are on the table, and that's not just pharmaceuticals, but also semiconductors, for example, as well. So he's got a lot of other sectors in his sights. Whether he actually pushes ahead and does that, it's very hard to say, because he likes to keep these things in his back pocket. He likes to have these negotiating tools in his pocket. So maybe he uses them as a lever, maybe he doesn't. It's very hard to know in this environment with the US administration, because, as you say, you know, Donald Trump can say one thing one day and another thing the next day and very much change his mind. But, you know, it is one sector very much that stands to have a significant impact if he were to go ahead and announce sectoral tariffs on pharma.
Bloomberg's EMEA News Director Ros Madsen, thank you very much indeed for the latest. Here's what else to be thinking then through today. 1:30 p.m. On the data front then, US non-farm payrolls, they're expected to come in a little softer than the previous month. Unemployment rate expected to remain at around 4.1%. Then, arguably more important on a day like today, given what's transpired over the last 48 hours, is what we hear from the Fed's Jay Powell, speaking at 4:30 p.m. UK time. How will he frame what we've seen in terms of the restructuring of this global economy and the implications for US recession risks and inflation? And today, NATO, the meeting concludes. We've been hearing, of course, from NATO members as they attempt to firm up their position as the US looks to lean more heavily towards Asia. So we continue to keep across that story for you as well. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go. Coming up, as Trump's tariffs boost uncertainty around the world, is a US recession now the base case? We get the reaction and how to think about positioning given the ruptures that we've seen across these global markets. That's coming up. This is Bloomberg.
We really need to change the way trade works around the world. It's tariffs, but don't get confused that these non-tariff trade barriers, they are the monster that needs to be slayed.
OK, US Commerce Secretary Howard Lutnick speaking to Bloomberg Surveillance after the tariffs were imposed, of course. President Donald Trump's big tariff rollout was supposed to reduce uncertainty for businesses. OK. But economists say it did the exact opposite. Some 92% of forecasters who responded to a Bloomberg survey said the announcement raises the risk of a US economic downturn over the next 12 months. Let's get a view now in terms of how the markets are positioning and how to think about the weeks and quarters ahead. John Hardy, Global Head of Macro Strategy at Saxo Bank, joins us. John, thank you for the time. How much further downside pressure do you expect to see for these markets, given the rout that we saw yesterday and the positioning today?
That's a very tough question. I think it's on everybody's mind here. But I think if we are moving towards crystallization of these recession risks in the months ahead, we do have solid risk, especially in the U.S., of a further markdown in the markets. Let's look at where where the U.S. markets got themselves, in this U.S. exceptionalism trade. over the last cycle. And I think there's plenty of risks that we see some further deleveraging and downside in the markets if these recession risks are realized. And it does look like they will be in coming months.
John, what comes to the rescue here? I'm just struggling to see who or what catalyst puts a floor under these markets. The Federal Reserve, there's a big debate there in terms of how far they can go given the inflation risks. The fiscal stimulus, fine, you might get tax cuts, but they're very domestically focused. The rest of the world is fiscally constrained, apart from maybe Germany. Where does that relief come from? The earnings story is going to be bleak given the supply chain ruptures. I'm struggling to see where the light at the end of the tunnel is at this point.
Well, I think we have to separate where we are right now and what we're looking at in coming weeks and the coming months and maybe even a couple of quarters to what the upward trajectory could be in the wake of that. And that is, quite significant potential in the U.S. if we have inbound investment, if we have the deregulation and tax cuts. Although I am seeing that the Republicans are circulating plans of a 40% tax on earners of over $1 million. So this is very interesting talk coming from Republicans. So I think this is just part of the where we are in the cycle, and I think it's down before it's up. I think the other side of this could be quite interesting in the U.S. I think the people are very excited about the European upswing that's there from German fiscal, opening up the fiscal taps. But I think maybe the markets are getting a bit ahead of themselves. We have to absorb the hit of tariffs and disruption to trade that all these moves from the Trump administration is going to cause, all the uncertainty there. And I think it's further down the road. So I put a question mark around some of the enthusiasm around European assets, although I do appreciate what this fiscal stimulus will do, what this reallocation of portfolios will do for the euro single currency itself, which is going to be significantly stronger, I think, if we look months and quarters ahead.
OK, so it sounds like you're very conservative in the near to medium term, but longer term, towards the back end of this year, it seems like your view is some of the positive catalysts come through both for the US, but also Europe as well.
Maybe more 2026 in the back end of this year, but that's a fair assessment of what I said, yeah.
OK, where do you land on the debate around the Federal Reserve? I mean, we've had two contrasting views from UBS on one side saying they're going to have to pull through and pull forward rate cuts versus Morgan Stanley that does not see cuts at all this year.
I think the market's assessment is very fair here, and we haven't fully priced in what the Fed could potentially do. We had them circulating that term, perhaps infamous term, transitory, on the impact of tariffs. I think what the Fed does will be established by what the labor market in the U.S. does. We see that unemployment rate ticking higher. If we see pain in the labor market, we'll see Fed cuts. And I think we could easily take another 25 basis points out of the current rate by the year end. We have about 100 basis points priced in right now. It could go to 125. And that's, I think, a base case here, assuming moderate stress in the U.S. labor market. Severe stress, we could go even further.
On the inflation part then, John, I mean, there's an argument that the inflation story in terms of higher prices will be more of a US story than a European, UK or possibly Asia story as well. Do the central banks of Europe and the UK have more clarity in terms of their ability to cut with lower pricing pressure?
Yeah, I think we're hitting a speed bump here in the economic outlook for the UK and for Europe. And I think you're seeing the adjustment there quite fairly so in the short end of the yield curve in both the UK and Europe. So I think those cuts will be realized, and I think we have a heck of a lot more to price in for the Bank of England, but also potentially for the ECB. So again, cuts across the board here on what the world is facing, which is the risk of not only a U.S. recession, but a global recession.
Does that mean, John, that you lean into the bond rally then? There's further to go there, yields lower, price on bonds. Where do you want to be sitting? What are your favoured kind of havens at this point?
Oh, well, one of my favorite havens when we're talking about yields going lower is always going to be the Japanese yen. I have very much a currency background, so I have both eyes on the Japanese yen here. We've seen a tremendous move lower in Japanese bond yields overnight. That's not negative for the yen. It's a reflection of the drop in yields globally. I think the two-year yield, if we're talking about fixed income, I think the risk is further out that there's stress at the longer end of the curve. So the short end of the curve for safe havens and cash, if you will. But in the currency markets, the Japanese yen very much so. And just wondering if we do see some proper sort of panic deleveraging. I wouldn't want to call that. But if we do, I'm curious if the dollar starts to at least fight back in places because of the, of course, the liquidity premium you have traditionally for the dollar as a safe haven. Not seeing that right now, and I think that's quite interesting, but I just put a question mark around whether there's some potential there.
Yeah, interesting. And the dollar has not played that safe haven role, at least in the near term, at least in recent days, given the drop that we saw yesterday. John, just before we let you go, what are your current assessments in terms of recession risks for the US?
Well, you never say 100%, but I think this I think the markets are pricing in very high odds of a U.S. recession this year. I think that's a fair assessment. We need to see that start to crystallize in the data. I'm not sure we'll see it in today's jobs report. It may take 2 or 3 more months of that to start to be to start to see it in the sort of more lagging data. But I think that's pretty secure in saying I think that's what we're set up for. The question is how deep and how quickly we can get to the uplift on the other side of this, of course. But I think we are headed towards at least a mild U.S. recession later this year.
OK, John Hardy, Global Head of Macro Strategy at Saxo Bank. Thank you very much for your time looking at a potential mild recession in the US. More cuts to come from the Fed, the ECB and the Bank of England, and more downside for these markets before things turn around. Coming up, South Korea takes a step closer to ending a power vacuum caused by the president's ill-fated decision to declare martial law last year. The details on that story out of South Korea next. This is Bloomberg. Now to some other stories making news this Friday. A South Korean court has removed President Yoon Suk-yeol from office over his martial law declaration. The move paves the way for a presidential election within the next 60 days, which Yoon will be barred from contesting. The court's decision marks a potential conclusion to one of the most turbulent political chapters in South Korea's recent history. The next leader will have to handle challenges, including President Trump's escalating tariffs and a more emboldened North Korea. And in a tap-for-tap move, Canada plans to impose 25% tariffs on US-made vehicles. Prime Minister Mark Carney says that the tariffs will apply to the non-Canadian content of vehicles that are assembled in the US and not on the shipment of auto parts. Speaking to reporters in Ottawa, Carney called President Trump's tariffs unjustified and misguided.
Three different sets of US tariffs remain in place and will continue to pose significant threats to Canadian workers and Canadian businesses. And while they have been imposed under different premises, some things are consistent. They are all unjustified, unwarranted, and in our judgment, misguided.
And Bloomberg has learned US officials have told their UK counterparts they will discuss Britain's proposal to reduce tariffs below 10%, but warned President Trump may decide that number is his permanent baseline for all countries. Conversations about a US-UK economic partnership, an idea previously backed by Trump, are expected to continue in the weeks ahead. Meanwhile, investors and economists say the threat of a global trade war is set to tip the balance at the Bank of England towards more interest rate cuts. Coming up, France's president gives a frank and direct response to those tariffs. We have the details. This is Bloomberg. Good morning, happy Friday. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Brace for more. Futures point to the global sell-off continuing after President Trump's tariff announcement wipes close to $2.5 trillion from the US stock market. That's the biggest decline since 2020. Oil extends a sharp drop after OPEC Plus unexpectedly increases supply. Show me the money. President Trump says he's open to reducing tariffs if other nations offer something, quote, phenomenal in negotiations. Plus, French President Emmanuel Macron urges companies to pause their investments in the US. Germany also pushing for a more robust European response to Trump's tariffs. So investors continuing to wake up to a fundamental restructuring of this global economy by President Trump. European futures pointing lower by 0.3%. moderating some of the earlier losses that had been flagged by the futures. But this, of course, coming on the back of a drop of 2.6% by the end of the close yesterday for European markets. It was a far worse picture for the US, though. You saw drops of close to 5% for the S&P 500 by the end of the close. The Nasdaq 100 was down 6%. Russell 2000 crushed, lower by almost 7%. Today, US futures pointed to further losses. S&P futures, as you can see, E-minis pointing down by 0.5%. Nasdaq 100 futures looking to lose 101 points. Here in the UK, the FTSE 100 under pressure, down 0.2%. Commodities feeling the pain again today. Let's flip the board and have a look cross asset. The moves into treasuries has been aggressive. You see that continuing today. Every part of the yield curve up until the 30-year, and that's the exception, is now below 4%. You're below 4% on the 10-year at 398. Yields down again 4 basis points. Euro dollar was at 111 just a few seconds ago. Currently up 0.4%. The Bloomberg dollar index spot dollar dropped. Biggest drop that we've seen intraday yesterday since 2005. Brent under pressure given the expectation that OPEC Plus will put more oil onto the market below $70 a barrel, dropping again today by 1%, and gold currently at 3,100. Let's get to the European response then to this changed tariff regime from President Trump. France's Emmanuel Macron is urging European companies to stop investing in the US in response to Trump's tariffs.
What's important is that we pause future investments or those announced in recent weeks until we've clarified things with the United States. Otherwise, what message would we send if we have major European players investing billions of euros in the American economy at a time when they are hitting us? So we need collective solidarity.
And the tariffs are predictably a major talking point at the NATO foreign ministers meeting in Brussels. Bloomberg's Olive Crook is there, has been following that summit for us. Ollie, France and Germany then pushing for a strong response to the tariffs. What is the latest?
Yeah, so everyone is sort of scrambling to figure out how to respond to these sort of Trump tariffs, that bevy that we got from the Rose Garden, that billboard with all the different figures coming out. And obviously the EU being hit with 20%, really on the higher end of what the EU had anticipated. They were looking at something between 10 and 25%, and they got that 20% figure. And we're already beginning to hear sort of different things from different leaders in terms of how to approach the negotiation with Donald Trump. We've obviously had the retaliation from Canada. We spoke about that overnight. We'll be speaking with the Canadian foreign minister very soon from here at the NATO HQ. But we heard from Emmanuel Macron telling French companies to basically pause investment in the United States. He does not have potentially quite the same amount of sway over those companies as Donald Trump does. Will he be able to affect that, just given how much pressure Trump has been basically exerting on all of these companies? And you heard from Robert Habeck, the German economy minister, yesterday, speaking in actually very, very powerful terms, referring to the tariffs that have been imposed by Donald Trump over the rest of the world, basically in the same sort of scale in terms of the impact as Russia's invasion of Ukraine. And I think that going forward, what we're going to get for the European leaders is you have trade ministers that are going to be meeting on Monday in Brussels in order to sort of thrash out how they're going to start to respond to this. I think the other question, Tom, that everybody is trying to grapple with is how do you basically quantify these non-tariff trade barriers that the Trump administration keeps talking about? How do you basically come to the negotiation in order to get those tariffs down? There's no sort of equivalent between a percentage point tariff rate and these non-tariff barriers. This is all part of the sort of the equation when all of these leaders are going to become to just sort of figure out how to respond to this. And we'll be speaking to the Canadian Forest Minister basically about their sort of approach on this. And could you see more cooperation between Canada and the European Union in trying to respond to the United States? Could you have a sort of G7 -1?
And that's why tuning in to that interview with, of course, the Foreign Minister of Canada that you'll be conducting later will be so important as well to hear the answers to some of those questions. Meanwhile, US Secretary of State Marco Rubio is trying to reassure European allies of the US's commitment to NATO. How challenging is that message, given that he and his administration has just hit them, many of them, with tariffs between 10 and 20%?
Listen, I think it depends on the audience that you're speaking to. I think that what we heard from Marco Rubio yesterday is exactly what the Europeans, what NATO wanted to hear. Basically, they said that he said that despite all the rhetoric, despite all the sort of reports in the media that he was being very critical of, he says that Donald Trump and the U.S. are totally committed to NATO, but they are committed to a NATO that takes their own defense a little bit more seriously, that is willing to spend more money on their own defense. And he reiterated that figure. Again, with many of the things that you hear from Donald Trump, you're not sure if these are sort of actual convictions predictions and policy proposals or something that will sort of pass, this 5% GDP spend on defense seems like something that the Trump administration is really hanging on to. And he went even further yesterday. We heard Marco Rubio say that the United States itself will commit to spending 5% of its GDP on defense. So I spoke to the Latvian foreign minister about what they heard from Marco Rubio and basically this sort of European commitment to getting to that figure. Have a listen to what she had to say.
We can't just throw Europeans in the same batch and say Europe is not spending. Europe is spending. This year it's already commitments for 750 billion. Sorry, in 24. So this year even more with Germany's historical decisions and others. So we are actually both understanding the threat, understanding the need to respond, but also hearing the message.
So if the new figure is 5%, Tom, the perennial question arises is how do you actually pay for it? That is going to be the more complicated thing for Europe. Marco Rubio, by the way, had a few suggestions of how to pay for it here in Europe. He said that basically you've been at the cost of the United States able to build all these magnificent welfare states. That's something that you might have to sacrifice.
Yeah, OK. All right. OK. Well, look, this is one area, of course, where Trump has managed to draw consensus around a view that was a bit of an outlier to start with in terms of the need for NATO members to spend more. Obama had been saying the same thing, of course. He built on that. But that is now consensus that he was, many would agree that he's right on that front in terms of the need for NATO members to spend more. So we'll see how that story adjusts as well. Oliver Cook on the ground for us ahead of that interview, of course, with Canada's foreign minister. That's in about half an hour's time. Ollie will be speaking exclusively with the Canadian foreign minister live on the opening trade. Now, oil prices continue to fall as President Trump's tariffs spur demand fears. And with OPEC Plus making a shock decision to increase output faster than previously announced. Wow, the timing. For more, I'm joined by Bloomberg's Stephen Stupczynski in Singapore. Stephen, we watched the tumble of oil prices yesterday, the two events, tariffs and then this amazing decision by OPEC Plus to actually put more oil on the market.
Yeah, this was not what the market was expecting. The market was expecting a rubber stamp event. They were expecting Saudi Arabia and other OPEC Plus leaders to tell countries to stick to their quotas. There have been some issues where other countries weren't sticking to that. And so this all seems to be by design. OPEC Plus came out and decided to triple the amount of oil that they were planning to add to the market in May because there were some member countries that weren't adhering. They were producing more than their quotas were set at. That also includes Russia as well. So this was clearly a shock and awe sort of event that led prices much lower, but it was all by design to sort of say, hey, you guys need to stick to your quotas or you're going to have some more pain in your future. Now, of course, that comes at the same time as the tariffs from the United States, which also led to fears of a wider trade war, retaliation from the EU, as we were talking about, but also potentially China, adding to a global trade war that would potentially reduce economic growth. And if you reduce economic growth, you use less oil, you use less gasoline, demand drops, and that's led to the bearish environment. So that 1-2 punch led to oil prices falling. But if you look at the Bloomberg Commodities Index, you're actually seeing across the board a lot of commodities falling, even gold, which has been interesting. I was just on the program yesterday speaking about how gold has had this record-breaking run as a safe haven asset, especially with the unpredictability of the Trump administration. But that was even swept up in the commodity sell-off yesterday. You had copper falling, you had soybeans falling, you had cotton falling, and it doesn't seem quite done yet. It all depends on what happens over the next few days and weeks as countries respond. But clearly, traders are getting rid of their assets, either taking a profit or getting out. As the future, it's very unclear to see what it holds.
Yeah, and that pressure, as you say, in the commodity markets continues today with copper under pressure again, gold down 0.3%. Stephen Stupczynski, though, on the shock and awe decision of OPEC Plus, the 1-2 punch. Stephen, thank you for giving us the details in the analysis on that story, roiling the oil markets, of course, and the pressure on Brent and WTI continues today. Now to some other stories making the news this Friday. It has been reported that the powerful wiretapping and cyber espionage service, the NSA, the National Service or the National Security Agency, was fired yesterday. That's according to the Washington Post. General Timothy Hoare was dismissed along with his civilian deputy at the NSA, Wendy Noble. The paper says the firings were advocated for by far-right activist Laura Loomer during a meeting with President Trump earlier this week. And Bloomberg has learned Republicans are weighing the creation of a new bracket for those earning $1 million or more to offset some of the costs of their tax bill. The move would be a stark departure from decades of GOP opposition to tax increases. Sources tell us conversations have included a new top rate that would be around 39 to 40%, bringing the rate back to where it was under President Obama. And Bloomberg has learned that Elon Musk's stint leading the Department of Government Efficiency is on track to end on May the 30th. That's when his 130-day role as a temporary advisor to President Trump is set to lapse. The White House counsel's office is in charge of determining when Musk has worked his 130 days. Sources say the world's richest person is expected to remain a Trump confidant even after his formal departure. Coming up, economic headwinds appear to cloud the global outlook for the travel industry this year. But booking site Omio sees bright spots ahead. We're going to speak to the CEO of that company coming up with a gauge on the health of the traveller globally. Stay with us. This is Bloomberg. Now, the deadline for TikTok to find a buyer or get shut down in the US is less than 24 hours away. President Trump said yesterday that the deal is close, yet significant hurdles remain. Bloomberg's Charlie Wells joins us now to walk us through the next step. So the clock ticking down on TikTok once again, Charlie.
Absolutely, Tom. And I mean, look, there have been a lot of potential suitors for TikTok. They range from Amazon to YouTube influencers to billionaire investors. But Bloomberg has learned that the deal that is potentially being taken most seriously by the Trump administration is a group that involves Oracle, Blackstone, and Andreessen Horowitz. Now, Bloomberg has learned that the dynamics of that deal would involve new investors owning about 50% of a spun-out TikTok US, old investors owning about 30%, and then ByteDance retaining just under 20% of that spun-out company. Now, something interesting here as well is the fact that ByteDance, under the terms of this potential deal, would retain control of those all-important algorithms. And that is a potential sticking point because the national security law from 2024 that was passed in the United States bars China or ByteDance from controlling those algorithms. They would be licensed out to that U.S. spin-out, but still controlled. That is one sticking point. Other sticking points include the fact that TikTok is very expensive. There have been a lot of suitors, but not just anyone can pick up the tab for this potential spin-out. And also the fact that ByteDance and China would need to bless this deal. Now, we heard just yesterday Trump talking about how he might use tariffs as a little bit of leverage here, but we do know that this is not the sort of precedent that China wants to set. They do not want the United States cherry-picking through some of their most valuable companies and using tariffs as leverage. So the deadline is tomorrow. Trump has signaled publicly that he could extend that deadline, and that is looking like it could be likely.
Okay, so those are geopolitical, political, and technical challenges as well as the cost, as you say. It made revenue of about $10 billion US dollars last year in the US market. Charlie, thank you very much indeed as we count down to that latest deadline around TikTok. Let's get back to some of the impacts on this global economy, particularly when it comes to the travel space, because while it's not known what effect exactly Trump's tariffs will have on travel this summer. This is one sector we're going to focus in on now. French hotel group Accor has told Bloomberg that bookings from Europe to the US are so far down 25%. And the increased risk of a US economic downtime is boosting uncertainty, of course, for the tourism sector. Someone who has a finger on the pulse of this sector is Naren Shaam, CEO of travel company Omio. Naren, thanks for coming into the studio.
Thanks for having me.
What is the slowing growth picture doing to bookings as you project out to the summer season?
Omio provides transportation across 45 countries. U.S. is a smaller portion of our business. It's still less than 10% for us. But we do see a 17% drop from Europeans traveling into United States. But we see an increase. We're still growing about 40% plus of Americans coming to Europe. So it's something we're tracking very closely to see how it evolves.
That's interesting. What do you put that 17% drop down to?
I think it's multiple factors. Uncertainty. but it's hard to predict. We need to understand much more around where it's coming from, what are the factors, but it's really hard to predict. It's multiple things in play.
What does the tariff regime that was announced this week from the Trump administration mean for your expansion plans as a business?
Yeah, so we think long term. We're not investing short term. Last year was our first year of profitability. We are expanding. So currently we operate in 45 countries. We're in Europe, United States, and we launched Southeast Asia, 6 markets in Southeast Asia. Last year we did $1 billion plus in sales, 10 million EBITDA. We're free cash flow positive. So we're more investing in the long term. I think in the 5-10 years out, I hope this is not a huge impact. We're tracking it, but we're not stopping our investment. Global transport is here to stay. Consumers are traveling. It's refreshing to think of travel plans, etc., and that's what we're here to fix.
And so you see changes, but you're not bracing as a business and as a CEO for a marked pullback in spending on travel on a slower economy.
We are tracking it in that if you take a step back, during COVID, which was only 5 years ago, we lost 98% of our revenue, and we had about 3 weeks of cash left. So we're coming out of something much more stronger. So we've trained the muscle of resilience a lot more. So I think we'll adjust. I think tariffs, we need to observe. There's, dollar weakening will have an impact. Weakening will have an impact on tourism to the U.S., to Europe. Oil prices will have an impact on the travel industry. So we're tracking that, but we're very resilient. So we won't make any short-term changes to how we're investing in growth and expansion and everything that we're doing.
And you have that global expansion plan. What is your priority market at this point?
So just a step back, Omio provides the most seamless, easy to use product around travel around the world. If you think of travel, you probably experienced this yourself. Buying flights separately from airport transfers, from trains, you go to different product, and you as a consumer need to piece it together. And we bring all of this in a single product, unified, where you can compare and buy quite easily. We are quite large in Europe now. We expanded to the US, and now we're launching Southeast Asia, and we're launching 2 more regions within the end of the year. But our goal is to be in 70 countries in 5 continents within the next 3 years. So that's really what we're focused on now.
What does AI do to your business model? This is the year, some venture capitalists have told me, this is the year of agentic AI, where we have our own personal AI agents in some form. I can have an AI agent that does my travel booking for me. Does that disrupt your industry? Does that disrupt your business model?
It's actually quite favorable for us because we built the plumbing into all these transport companies. We have 2,500 partners, suppliers that we plug into. So I think AI will accelerate how fast we grow. Agentic AI is probably the most transformational innovation that's come into tech in general, but it's not just travel. It's going to go after every industry. For us, we've collected about 3 petabytes of data. So every train, every bus, every flight, every price over the last decade, and we're storing that. And we're building products on top of that data. So I think for us, I think we're looking at how it's going to accelerate. I've given a goal that 80% of the whole organization needs to use AI first within the end of this year. So it's going to make both internal processes, but more consumer products are going to get much better with AI.
Okay, you recently raised $120 million in terms of debt facility.
Yeah.
What are you going to be spending that on? Acquisitions is part of the mix. If it's acquisitions, what are you looking to add?
Yeah, so it's a debt facility we can draw down if we choose to.
Yeah.
We are looking at M&A. In the next 3 to 4 years, we want to be global. If you think of like another industry like music streaming or search or alternate accommodation, a brand comes to your mind. So if you think of transport globally, hopefully you think of Omio, and that's really what we're solving for. So M&A is an accelerator for us, but given how disciplined we were during COVID, that muscle is still there. So we're going to go about it in a very structured manner, but we are looking to make acquisitions.
Naren, thank you very much indeed. CEO, Naren Shaam, CEO of Omio, on what the travel space is experiencing right now and those expansion plans. Thank you very much indeed. There's plenty more coming up. Stay with us. This is Bloomberg.
Taxes and deregulation were the 3-legged stool, and right now the focus is on tariffs.
As things stand now, we're headed to recession, and it's very clear that this is a tax on businesses and households.
The U.S. is known for the innovation and the stuff we create And I think it's exceedingly burdensome for small companies like ours.
In the next couple of months, the labor market still stays okay.
As the adage goes, if the U.S. is going to have a slowdown, other regions probably are going to be worse.
Guests on Bloomberg Television, of course, discussing their outlook for the months ahead after President Donald Trump imposed the steepest American tariffs in a century. Now, we saw $2.5 trillion of market cap wiped off the US markets yesterday. Here's how it broke down on an individual company basis, with tech feeling a lot of the pain. But banks were not immune as well. You can see the banking sector as well. The likes of JP Morgan, Bank of America also being hit in terms of the market cap valuation squeeze on the back of those tariffs. Apple, though, was the biggest pain trade yesterday on a corporate basis. The market cap being reduced by $274 billion US. That stock is down 19% year to date. Tesla also saw pain as well. That stock down about 30% year to date and saw its market cap reduced by about $50 billion US just in yesterday's trade. Let's flip the board and have a look at one area where US exceptionalism remains, and that is on inflation expectations. That is the white line. You're looking at US 2-year inflation swaps, the white line. You can see that divergence in terms of inflation expectations for the US versus many of the counterparts in the rest of the world, Australia, the UK and France. That is a challenge, of course, for those betting on 4 or more rate cuts from the Federal Reserve this year. Let's flip the board and have a look at the non-farm payrolls, because that data point is later today. And then, of course, you have Jay Powell, arguably more important in terms of what he has to say in response to the tariff regime and the upending of this global trading order. Non-farm payrolls expected to come in at 140,000. Bloomberg Economics says it will reflect some, but not all, of the ruptures, of course, in the workforce of the federal government. 4.1% is the unemployment number expected. That data drops later today. And then, of course, you have Jay Powell and his comments. The opening trade is going to walk you through all of this, the market route that we've seen, the readjustments, how to position, with some great conversations coming up. The opening trade is up next. This is Bloomberg.